When it comes to investments, there are a lot of options available. You can invest in stocks, bonds, mutual funds, real estate, and more. However, one investment strategy that's often overlooked is stock options. Stock options can be a great way to increase your profits while reducing your risk at the same time. In this comprehensive stock options training video, we will discuss and answer the following questions. Why invest and trade using stock options? How do you get started trading stock options? What are the common misconceptions around stock options? What's the difference between active and passive investing? And what are the pros and cons of each? We will discuss the 5 best option trading strategies and how they work. Individually, we will focus on the covered call, the leaps option strategy, the strangle option strategy, the Iron Condor, and the vertical spread. We will also touch on naked option strategies and how they work. How do we utilize option strategies to beat the S&P 500? And we will discuss the S&P trend line and how we utilize that to beat the market. How do we use multiple methods to confirm our options trades? What's options mathematics? And we will also touch on fundamental stock analysis as well as technical and even conference calls, quarterly earnings reports, and news. Why invest and trade using stock options? Stock options are a great way to invest and trade because they offer a lot of benefits. For one, they allow you to control a large amount of stock with a small amount of money. This gives you more leverage and makes it easier to make bigger profits. At the same time, options can be used to reduce risk, which we'll show in some upcoming examples. For myself and many others, stock options can be a business in itself. Imagine being your own boss and waking up to trade the market in the morning. You put on a few trades and then come back before the market closes and make any necessary adjustments, all while consistently making money. You now have the freedom to spend with your family. Since you can work from anywhere via your laptop, you can travel and at the same time have money and time to do it. How do you get started trading stock options? I've always been interested in the stock market and finances. So for me, it started with buying mutual funds and stocks. I invested in a 401k with the company that I worked for, and I always tried to max out my 401k. This money's passively invested, so I don't touch it. I just let Fidelity handle it conservatively through a well-diversified, safe investment portfolio. Then I started learning a little bit about stock options. I started watching tastytrade.com with free daily options training videos, and I was hooked. It was stock options as a side business for me. Average gains through passive investing in the S&P 500, which is the stock market benchmark, are typically about 10% a year. This is since 1954. So I was certain I could earn 20, 30, 40% or more annually, no problem. But hey, not so fast. There was a bit of a learning curve and I learned some hard lessons along the way. The 2008 stock market crash got me. I lost quite a bit by going too big and trading naked futures options. That's okay though. I'm grateful that I didn't give up and I pushed through and continued to rebuild. I think it helped me have an appreciation for the stock market and the power of the market as well as stock options specifically. It showed me that you can lose money, however, you can make a lot of money as well. The best way to get started is to find a stock options broker. A good broker will provide you with the necessary tools and resources to help you succeed. Once you've found a good broker, the next step is to open an account and fund it. You'll then need to decide what type of options you want to trade. What are the common misconceptions about stock options? When people hear the term stock options, right away they think of gambling and losing all their money. Many people view options as just too risky. This couldn't be further from the truth. Options can be used to reduce risk in a portfolio. Stock options provide a lot of flexibility and choices as well. You can trade options for different underlying securities such as stocks, ETFs, and indexes. One of the most important features of stock options is that you can pick your strike prices. Most people don't know this. is a huge advantage over just buying and holding stocks. Therefore, you can pick your own probability of profit. We cover this in full detail under the upcoming options math section. Another misconception is that you need a lot of money to trade stock options. This is also false. You can start trading with as little as $500. What is the difference between active and passive investing? Passive investing is a long-term strategy in which you buy stocks and hold them for an extended period, usually years or even decades. The goal of passive investing is to ride out the ups and downs of the stock market over time and ultimately end up with more money than you started with. Many passive investors believe that trying to beat the market is a fool's game and that the best way to make money in stocks is to buy them and let time do its work. Active investing is a short-term strategy in which you buy and sell stocks frequently in an attempt to make money from the market's ups and downs. Active investors believe that they can beat the market by timing their trades and making smart decisions about when to buy and sell. Many active investors use stock options as a way to increase their profits and reduce risk. What are the pros and cons of passive investing? There are a few advantages to passive investing. First, it's a relatively simple strategy to implement and maintain. You could put your money into a SPY ETF fund that mirrors the S&P 500 and be done with it. You could also hire a financial planner and have him or her manage your portfolio for you. Secondly, it doesn't require a lot of time or effort to be successful. It can be a very effective way to build wealth over the long term. Of course, it is more of a slow and steady pace at a 7 to 10% per year return on average. The main disadvantage of passive investing is that it can be difficult to achieve above average returns. Since you're not actively trying to beat the market, you're likely to end up matching the market's performance. And if the market goes through a prolonged period of decline, as it did during the financial crisis of 2008-2009, your portfolio will suffer as well. What are the pros and cons of active investing? Active investing has a few great advantages over passive investing. First, it could potentially generate much higher returns. It takes skill and experience to outperform the market or the S&P 500. However, if you study the market and follow a disciplined set of rules, it is possible to beat the S&P 500. Second, it can protect against market declines. Of course, no one typically sees market declines coming, so for active investing, to have a leg up in this area, you have to be able to predict movements better than others. This is a difficult task, and even the best active investors only get it right about half the time. A set of rules and always having money on the sidelines can be key to being successful. And third, it can be a more exciting and engaging way to invest. I think the more people engaged in the stock market, the better. Knowledge is good, and more people means more liquidity and growth for everyone. It brings stability to the market. The main disadvantage of active investing is that it's more time consuming and resource intensive. You need to constantly monitor the market and make trades quickly when opportunities arise. And because you're trying to beat the S&P 500, there's always the risk that you could lose money. What are the top 5 mistakes that option traders make? Many traders do not trade liquid underlines. We want to trade stocks with 2 to 3 cent wide strikes. We do not want to trade stocks with a dollar difference between the bid and the ask price. This means we're giving up that dollar as soon as we are filled and put on the trade. So we're almost guaranteed to lose. Traders also don't understand options mathematics. As a result, they make foolish decisions that cost them money. Instead of picking the strike prices and strategies that provide a high probability of profit, they pick low probability of profit strategies. Another mistake traders make is not having a plan. A trading plan is essential for success. Without a plan, it's easy to make impulsive decisions that can cost you money. You want to have a set of rules that you trade by. Another common mistake is not managing risk. Stock options are a risky investment, and if you don't manage your risk properly, you can lose all of your investment. You manage risk by using stop losses or wings on high-priced stocks and staying small and not using too much of your buying power. Finally, many traders fail to take advantage of the leverage that stock options provide. Stock options allow you to control a large amount of stock for a relatively small investment. This leverage can be used to your advantage, but if you don't use it properly, it can also lead to losses. What are the 5 best options trading strategies and how do they work? Options trading strategies are the key to successful options trading. They provide a roadmap for how to trade options and make money in the stock market. There are many different option trading strategies, but not all of them are created equal. The 5 best options trading strategies are writing covered calls, buying leaps, selling strangles, selling iron condors, and selling vertical spreads. What is a covered call? A covered call is an options strategy that involves selling a call option on a stock that you already own. The call option gives the buyer the right to purchase your stock at a set price, the strike price, on or before a certain date, the expiration date. By selling the call option, you are agreeing to sell your stock at the strike price if the option is exercised. Let's show how to sell a covered call on the Tastyworks trade platform. We'll take a look at Disney, which we think is a good stock long term, and we want to own it. So we buy 100 shares of the stock at the current price. Then, at the same time, we sell a call option against the 100 shares. We'll pick the 115 strike price since it's just out of the money and we can collect about $200 in premium. By doing this, we cap out max profit at the 115 call strike price. In return for doing that, we are collecting the $200. So we still have a max profit of $1,100 if the stock moves up to the 115 price. If the stock price stays anywhere below the 115, then we keep the $200 collected. What are the risks of writing covered calls? The biggest risk of writing covered calls is the exact same risk of owning the stock. The stock price could go down. When the stock price goes down, you lose money. However, you lose less than owning the stock if it goes down because you'll keep the premium collected from the call option since it will expire worthless. Another risk is that the stock price could rise above the strike price and you would be forced to sell your shares at a lower price than what they are currently worth if the stock continued to climb. However, this is a first world problem since the stock price increased and you still made money on the long stock. How much money can you make with covered calls? The amount of money that you can make writing covered calls depends on the stock price movement and the premium collected. If the stock price stays relatively static, you will make money from the premium collected. If the stock price goes up, you'll make money from both the appreciation in the stock value as well as the premium collected. However, if the stock price goes down beyond your break-even point, you'll lose money. There's no average return for selling covered calls. The average return for the S&P 500 is around 7 to 10% per year since its modern structure in 1957. The key is only to write covered calls on stocks that you believe will go up in price. I like to sell the 30 delta call with 30 to 59 days to expiration and collect 3 to 4% of the value of the stock every month. For instance, if we take a look at Chewy, it's trading at $38.81. You can sell the 45 call and collect $2.08 in premium. Let's say you keep half the premium before rolling to the following month. That equates to about 2% collected per month, or over 12 months, 24% per year on average. This is more than double and much better than the 10% average return of the S&P. Again, you sell covered calls in stocks you think will move up in price and don't mind owning long term. What stocks are good for covered calls? The best stocks for covered calls are typically large, stable companies with a history of paying dividends. These stocks tend to have less price volatility than other stocks, so there's less risk of the stock price moving sharply against you. They are often more expensive stocks. However, if you're going to use the buying power to buy the stock, you might as well collect the dividend as well, which adds to your return. On the other hand, good lower price stocks that are undervalued and you believe will go up in price are great as well. Since you buy 100 shares of the stock with one covered call, the lower priced stocks keep the buying power requirement manageable. Most important is picking a stock that you want to hold for the long term and think is going to increase in price. If you are bullish on the stock and believe it will continue to rise, then you can roll your covered call by buying back the option and selling a new one with a higher strike price. This allows you to keep collecting premiums as the stock price increases. If you are inside of 21 days to expiration, then you can look to sell the call option in the following month. When should I close my covered call options? You should close your covered call options when the stock price reaches your target strike price or if you no longer believe the stock will continue to rise. Once your stock price has been reached, you will be near max profit. If you still believe in the stock and want to hold it long term, you can buy back your call and move it out higher in the next month to collect additional premium. Let's summarize covered calls. Covered calls are a simple and popular option strategy that can help you generate income from your stock portfolio. By selling call options on stocks that you already own, you agree to sell your shares at a set price if the option is exercised. However, you also collect the premium from the option if it expires worthless. Covered calls are best used on large stable companies with a history of paying dividends and or lower priced undervalued companies that you believe will increase in price and have a strong potential for growth. Okay, what are LEAPS options and how do they work? LEAPS options are long-term options that have an expiration date that is further out than traditional options. The name LEAPS stands for Long-Term Equity Anticipation Securities. LEAPS options were created in 1990 to give investors the ability to trade options with a longer time frame. How do LEAPS option strategies work? You purchase a LEAPS call option on a stock that you believe will go up in price. The nice thing about LEAPS options is that they're much cheaper than buying the stock outright. If the stock does go up in price, your profits can be huge. I like to purchase a call option that is more than 1 year out in time, closer to 2 years. Days to expiration is preferred as it doesn't cost much more than the 1 year LEAP. The strike price that I like to use is deep in the money. That will give me the best bang for my buck. It also more closely replicates owning 100 shares of stock. One advantage of buying LEAPS options over buying stocks outright is that you don't have to put up as much money. When you buy a stock, you're responsible for 100% of the price. When you purchase a LEAPS option, you only have to put up a small percentage of the price. This is called leverage and can be a powerful tool when used correctly. Of course, leverage can also work against you. However, since we are buying the option with this LEAPS strategy, the amount you pay for it is the max loss that can be incurred. So another huge advantage with this strategy is that the leverage only works in your favor and not against you if the stock moves down. When is the best time to use the LEAPS option strategy? The best time to use this strategy is when you are bullish on a stock and you have a longer term time frame in mind. For example, if you believe that a stock will be going up in price over the next year, but you don't know exactly when. A down market or bear market is often a great time to start buying LEAPS options. This is because the stock prices are usually depressed and you can get a real deal on LEAPS options. So how do we put on a LEAPS options trade? Let's take a look at the Tastyworks trade platform. And let's say we're bullish on DocuSign. And we believe that it will be going up in price over the next year. You could purchase a LEAPS call option with a strike price of $40 that expires in January of 2024. The current price is $64.07. Doing this will cost $3,285 to control 100 shares of the stock. This is versus buying 100 shares that would cost you $6,407 if you were to buy the stock outright. How do we manage the LEAPS option strategy? There are different theories on managing LEAPS options trades. I'll give you a couple of different methods that are commonly used, then I'll tell you what I like to do. The first method is to set a price target for the stock and sell the LEAPS call option when the stock hits your target price. This will allow you to lock in your profits and avoid letting the trade run against you. The second method is to hold the LEAPS call option until it expires. This is a more aggressive approach and it can lead to bigger profits if the stock continues to go up in price, but it also carries more risk because you're letting the trade ride. I'd like to use a combination of both methods. I'll set a price target for the stock and hold the LEAPS call until it hits my target, but I'll also sell half of my position at my target price to lock in some profits. This way I have some downside protection if the stock reverses course, but I still have a chance to make some big profits if the stock continues to go up. So to summarize the LEAPS options strategy, it can be a great way to profit from stocks that you are bullish on. It allows you to get exposure to the stock for a fraction of the price of buying it outright. And if the stock goes up in price, your profits can be huge. Just be sure to use this strategy only on stocks that you are confident will go up in price and monitor your positions. What is the Strangle option strategy and how does it work? A strangle is an options trading strategy that is utilized when the trader believes that the underlying asset will stay within a range in the near future. The key to this strategy is selling both an out-of-the-money put and an out-of-the-money call with different strike prices but in the same expiration date. The trade is profitable if the price of the underlying asset ends up being between the strike prices of the two options at expiration. What are the benefits of selling a strangle? There are many benefits to selling strangles. Strangles allow us to take advantage of time decay. Time decay is the gradual loss in value of an option as it approaches its expiration date. Since we are selling both a put and a call, we are double dipping on theta or time decay. As we're selling options, we are collecting premiums which give us a built-in edge from the start. We are selling both sides, so we are collecting premiums on both sides as mentioned, which increases the profit and reduces the risk. Risk is reduced because we can only lose on one side. We also don't need the underlying asset to move to make money. It just needs to stay relatively still and within the range of the short strikes. Lastly, the strangle is easy to manage since there are no protective puts or calls, so you just need to roll the option legs. When should you sell a strangle? The ideal time to sell a strangle is when the IVR is high. When IVR is high, the premium collected will be high as well. Even though IVR is high, we want to put on a strangle when we don't believe the stock will move too much. I like to look at strangle opportunities after a large drop in a stock, possibly from missing earnings or some other event. Often the big drop will limit a further big drop, and the reason for the big drop will be enough to keep the stock from moving back too high and past the short call strike too fast. After a big drop, IVR is still often high to allow for a good amount of premium to still be collected when the trade is put on. As with any option strategy, when looking to put on a strangle, we want to make sure that the underlying asset has decent liquidity. This is important because when we sell options, we are selling the right to someone else to buy or sell the underlying asset from us. If there's not enough liquidity, it may be difficult to find someone to take the other side of the trade. How do we sell a strangle? Selling a strangle is relatively simple. You want to find an underlying asset that you believe will stay relatively still in the near future and has high IVR. Once you have found the underlying asset, you want to sell a put and a call with different strike prices, but with the same expiration date. I like to use options that are about 30 to 45 days out. Both options are sold out of the money at about the 20 to 30 delta. This allows for a lower chance of being exercised and we can still collect a decent premium. How do we manage a strangle? With premium selling strategies, defensive tactics revolve around collecting more premium to improve our break-even price and further reduce our cost basis. With short strangles specifically, rolling the untested side or the non-losing side closer to the stock price when the tested side, which is the losing side, is breached is optimal. At around 21 days to expiration, I look to roll the strangle to the next month or cycle and collect more premium if the IVR is high. Adjustments can also be made at this time to recenter the strangle, or if you think the stock will come back within a range, the strangle can be maintained at the same strikes when the trade was put on. When do we close strangles? The first profit target is generally 50% of the max profit. This is done by buying the strangle back for 50% of the credit received at order entry. How do we lose with a strangle? Just like with any trade, it's very possible to lose when selling a strangle. The biggest threat to our short strangle is if the underlying asset price moves too far in either direction. If this happens, we can lose a lot of money very quickly. When this occurs, we manage and roll the untested side to collect more premium. To better understand how to sell a strangle, let's look at an example. We are going to sell a strangle in Snap since it has a high IVR of 69 and has been trading within a range for the past 4 months. We will use the Tastyworks trade platform. We go to the trade tab and punch in the ticker SNAP. I like to use the curve mode so that I can visually see the profit zone in the green. Now we go to the strategy tab and select short strangle. In this case, we are selling the 26 strike put and the 40 call. We collect $249 immediately upon placing the trade. We place the trade with 35 days to expiration. The buying power effect we are using is $332. So it's a cost-efficient way of investing since we are using $332 and collecting $249. Now, if you look at the green area, which is the P&L at expiration, we see the max profit is $249, which is the amount we collected up front. As long as the stock stays above the 26 put strike and below the 40 call strike price, we keep the max profit. We don't start losing money until the stock moves below about 23.5 or above $42.40. So as long as the price stays between those prices, we still profit. Okay, to summarize, the short strangle strategy is a great strategy to use when IVR is high and you think the stock will stay within a range. You can collect high premiums and it's easy to adjust when the stock does move. It is one of my favorite strategies since you can make money if the stock stays where it is or moves up or down within the profit range. What is the Iron Condor option strategy and how does it work? An Iron Condor is a directionally neutral, defined risk strategy that profits from a stock trading in a range through expiration of the options. It benefits from the passage of time and any decreases in implied volatility. It's constructed by holding one long put and one short put with different strike prices and also holding one long call and one short call with different strike prices. The different strike prices will create 4 different legs or options contracts. The directional assumption is neutral. The setup is done by selling the out-of-the-money call vertical spread and an out-of-the-money put vertical spread. We should do this when implied volatility is high. The max profit is the net credit received when the trade is put on, and it's realized when the underlying settles between the short strikes of the trade at expiration. The break-evens are calculated. On the upside, it's the short call strike plus credit received, and on the downside, it's the short put strike minus the credit received. What is the best approach when selling Iron Condors? We shoot for collecting 1/3 the width of the strikes in premium upon trade entry. For example, if we have an Iron Condor with 3-point wide spreads, we should look to collect at least $1 for the trade. This gives us the probability of success of around 67%, which is acceptable. What are the benefits to selling iron condors? There's a few key benefits. The first benefit is that it's a defined risk strategy. You know the max loss when you place the trade. It's important because it allows you to manage your risk on every trade. Another key benefit is that it can be used in almost any market condition. Whether the market's moving up, down, or sideways, the Iron Condor strategy can be used to profit. Another benefit is that it benefits from the passage of time and any decrease in implied volatility. So you benefit by collecting premium from time decay. Lastly, Iron Condors are great for IRA accounts since they are defined risk and use very little buying power. When is the best time to put on an Iron Condor? Iron Condors are best sold in high volatility environments. This is because the increased volatility will increase the premiums that you receive for selling the options. This allows the short strikes to be set wider as well to allow for more movement in the stock price while still being profitable. We want the stock to stay within a range when selling Iron Condors. For this reason, I like to put them on after a large move down in the stock. This is because the move is already priced in and it likely won't continue to go down too much more. At the same time, due to the reason for the move down, it's not likely going to be rebounding anytime soon and rocket back up. In this type of situation, the volatility is likely still going to be high, so a good premium can often be collected. How do we manage Iron Condors? We manage Iron Condors when one of the short strikes on the verticals is breached. We then adjust the untested side or profitable side of the spread. We look to roll the untested spread closer to the stock price to collect more premium. I like to cut the deltas in half as long as there's still good premium to collect, generally 50 cents or more. We can go down as far as rolling our untested spread to the same short strike as our tested spread, which creates an iron fly. When do we close Iron Condors? Much like several other standard premium selling strategies, we close Iron Condors when we reach 50% of our max profit. This can increase our win rate over time, as we are taking risk off the table and locking in profits. So let's take a look at an example and sell an Iron Condor in Square since it has a high IVR of 68 and it's a good stock that has been hit and is trading in a range. We'll use the Tastyworks trade platform. So we're going to go to the Trade tab and punch in the ticker SQ in the upper left. I like to use the curve mode so that I can visually see the profit zone in green when the trade's put on. We go to the Strategy tab and select Short Iron Condor. The Tastyworks platform will automatically set you up to sell an Iron Condor. In this case, the stock is at $118. We sell the 95.85 put spread and the 140.150 call spread. We collect $335, which is about 1/3 the width of the $10, which is really $1,000 spread. We're placing the trade with 32 days to expiration. The buying power effect we are using is $665. So it is a cost-efficient way of investing since we're using $665 and collecting $335. Now, if you look at the green area, which is the P&L at expiration, we see the max profit is $335. This is the amount we collected up front. As long as the stock stays between 95 and 140, the short strikes, we keep that max profit. We don't start losing money until the stock moves to around $91.65 on the downside or above 143.35. So if the stock stays where it is or even moves a little, we are still profitable. So to summarize, the Iron Condors are a great strategy to use when we are non-directional on a stock and want to limit our risk. You can collect high premiums and they don't use a lot of buying power. What is a vertical spread options strategy and how does it work? A vertical spread is a directional strategy made up of a long and a short put or call at different strikes in the same expiration. Vertical spreads allow us to trade directionally while clearly defining our max profit and max loss when we enter the trade. It's also known as defined risk. A long call vertical spread is a bullish defined risk strategy made up of a long and a short call at different strikes in the same expiration. This is a bullish trade. We buy the in-the-money call and we sell the out-of-the-money call. And we do this in low implied volatility. When we are long, we are buying the spread. The max profit is the distance between the call strikes minus the net debit paid. And we calculate the break even by the long call strike plus the net debit paid. The long put vertical spread is a bearish defined risk strategy made up of a long and a short put at different strikes in the same expiration. We do this in low implied volatility as well because we are buying the spread. We will set it up by buying the in-the-money put and selling the out-of-the-money put. It's a bearish directional assumption, and you can see the max profits and how to calculate the break-evens as well. Moving on, the short call vertical spread. We do this one in high implied volatility. A short call vertical spread is a bearish defined risk strategy made up of a long and a short call at different strikes in the same expiration. We want the stock price to move down when we put on a call vertical spread. We sell the out of the money call closer to at the money, and then we buy one further away out of the money. The max profit is the credit received from opening the trade. So we know max profit when we place the trade. And the break even is the short call strike plus the credit received. And then lastly, the short put vertical spread is a bullish defined risk strategy made up of a long and a short put at different strikes in the same expiration. This is a bullish trade, so we want the stock price to increase. We sell the out of the money put closer to at the money, and then we sell a further away out of the money put, or we buy and further away out of the money put as a wing. The ideal implied volatility, as mentioned, is high, so we want to sell options in high implied volatility. The max profit is the credit received from opening the trade, so we know our max profit right off the bat. And the break even is calculated by the short put strike minus the credit received. When first starting to trade options, it can be a little confusing with the terms as far as long, short, buying, and selling. So when we sell a vertical spread, we are short a vertical spread, a vertical call, or short a put spread. This is selling. When we sell, we collect a credit. When we buy a vertical spread, either a call or a put spread, we do this in low implied volatility, and when we buy it, we are long a vertical spread, and we pay a debit. It's also called the debit spread. So selling equals short equals a credit. Buying equals long equals a debit. And we sell vertical spreads in high volatility and buy vertical spreads in low volatility. And those are directional plays. What are the benefits of vertical spreads? There are a couple of key benefits to vertical spreads, which is why they are such a popular strategy amongst traders. First of all, they're defined risk trades. So one of the biggest advantages with the spreads is your max risk is known from the outset when you put the trade on. This is in contrast to many other option strategies which involve unlimited risk. Vertical spreads also have limited capital requirements. This is because when you sell vertical spreads, you are buying a protective put or a call. This makes the trade define risk, so you're only required to put up the max loss for the trade. If you are buying the spread, then your max outlay is the amount that you pay when you put the trade on. When is the best time to use a vertical spread? Vertical spreads allow us to trade directionally while clearly defining our max profit and max loss at entry. When implied volatility plays more of a role with naked options, it still does affect vertical spreads. We prefer to sell premium in high IV environments, and we buy premium in low IV environments. We like to put on vertical spreads with about 45 days to expiration. When IV is high, we look to sell the spreads and we hope for an IV contraction. When it is low, we buy the vertical spreads to stay engaged and also use it as a potential hedge against our short volatility that we have in our portfolio. How do we manage vertical spreads? Since the max loss is known at order entry, losing positions are often not defended. Some people prefer to roll the spreads at around 21 days to expiration. We look to roll for a credit, which is sometimes difficult with vertical spreads. If we can't roll for a credit, we can let the trade expire for the loss and put on a new trade if we think it will come back in the next month cycle. When do we close vertical spreads? Profitable vertical spreads will be closed at a more favorable price than the entry price. A good profit goal is around 50% of max profit. Okay, let's show how we will sell a short put vertical spread in Snap, since it has a high IVR of 73 and we think it is a good stock at the lower end of its trading range. So we're bullish and expect it to go up in price. We'll use the Tastyworks trade platform. So we're going to go to the trade tab and punch in the ticker SNAP. I like to use the curve mode so that I can visually see the profit zone in green. We go to the strategy tab and select short put vertical. The Tastyworks platform will automatically set you up to sell a short vertical. In this case, the stock is at $31.73. We are selling the 31 strike put and buying the 28 put. We collect $122 immediately upon placing the trade. We place this trade with 32 days to expiration. The buying power effect, which is the buying power we are using, is $178. So it's a cost-efficient way of investing since we are using just $178 and collecting $122. Now, if you look at the green area, which is the P&L at expiration, we see the max profit is $122, which is the amount that we collected up front. We do like to collect about 1/3 the width of the strikes on a vertical, so we are definitely doing it in this case. As long as the stock stays above the 31 put strike, we keep the max profit. We don't start losing money until the stock moves to around $30. So if the stock stays where it is or even moves down a little, we are still profitable. As vertical spreads, they are a great strategy to use when you are directional on a stock and want to limit your risk. You can collect high premiums when you sell vertical spreads, and they don't use a lot of buying power. You can also buy vertical spreads if you are directional and you know your max loss upon trade entry. What are naked option strategies and how do they work? A naked call is an option strategy where you sell a call option without owning the underlying stock nor buying another call as a stop loss. It's considered a naked call because you are exposed to the risk of having to sell shares of the underlying stock at the strike price if the option is exercised by the buyer. Selling a naked call is a bearish strategy because you are expecting the stock price to go down. When it goes down or stays where it's at, you profit. You can either buy or sell a naked call. If you sell a naked call, you are obligated to sell shares of the underlying stock at the strike price if the option is exercised. However, if you buy a naked call, you have the right to purchase the shares of the underlying stock at the strike price, but you are not obligated to do so. There are a few advantages to selling naked calls. The first advantage is that it can be used as a way to bet against a stock that you believe is overvalued and positioned to move down in price. In order to bet against a stock that you believe is overvalued, you can short it. Shorting just means to sell shares against it. It's the opposite of being long or buying the stock. By selling a naked call above the current price of the stock, you collect a premium. If the stock price moves down, you can roll down and collect additional premium. When you sell a call, you collect premium and are actually getting paid for taking the risk of having to sell shares of the underlying stock if it does move against you. Lastly, selling a naked call requires less buying power than shorting the stock outright. This allows the opportunity to make a higher return on investment. What are the downsides to selling a naked call? You need to be comfortable with the risk involved in selling naked calls. The biggest risk is that the stock price can go up and you may be assigned the short stock. If the stock continues to go up, you continue to lose money. If the stock price goes down too much, you will miss out on additional profits that you would have had if you shorted the stock outright. However, we shouldn't allow ourselves to think this way since we keep the premium collected up front and the trade will be profitable, which is what we wanted when we placed the trade. When should you sell a naked call? A naked call can be sold in several different situations. It's a good strategy to use when you're bearish on a stock and think the price will go down. It can also be used as a way to short a stock at a higher price. So if you are bearish on the stock and want to short it anyway, why not sell a call and try to get in at a higher price? You collect a premium in the meantime. Lastly, it's a good strategy to use to generate income from your investment portfolio. When you sell the naked call, you collect a premium. If you're not assigned, you can roll down the call to the following month and collect additional premium. You can continue doing this every month until you're assigned. Selling naked calls is a way to add negative delta to your portfolio to make it more delta neutral as opposed to just being long everything and hoping that the market goes up. So you can profit if the market moves down as well as up. How do we sell a naked call? Selling a naked call is relatively simple. First, you need to choose the stock or ETF that you want to sell the call on. You want to make sure you are bearish and believe the stock price will decrease in value. Next, you need to choose the expiration date of the contract. I suggest selecting a date that is closest to around 45 days to expiration. We pick this expiration date to maximize profit and minimize risk. Lastly, you need to choose the strike price. This is the price you are willing to sell shares of the underlying stock at. The ideal strike price should be somewhere between the 16 and 30 delta. When trading short naked options, selling an option of the opposing type, for instance, selling a put against a short call that is being tested, can be one defense mechanism. This reduces the directional risk of the position and also allows you to collect additional premium and extend the break even. If the trader's assumption on the underlying hasn't changed as expiration approaches, the position can be rolled to the next expiration cycle to extend the time in the trade and collect more premium. When do we close a naked call? A profitable short naked call will be closed at a more favorable price than the entry price, and the first goal is typically 50% of the max profit. How do we lose selling naked calls? The underlying stock price could rise, in which case we would be assigned the short shares of the stock at the strike price, and the loss would be equal to the difference between the strike price and the entry price minus the premium collected. The max loss for a naked call is unlimited since there's no limit to how high the underlying stock price can go up. To better understand how selling a naked call works, let's look at an example. Let's look at KSS Kohl's. It's near the top of its 12-month range. We'll use the Tastyworks trade platform. So we're going to go to the trade tab and punch in KSS in the upper left. I like to use the curved mode so that I can visually see the profit zone in green. We go to the strategy tab and hit short call option, and the Tastyworks trade platform automatically sets you up to sell the short call. In this case, we're selling the 65 strike call for $1.97 with 35 days to expiration. So collecting $1.97 immediately upon putting on the trade. The buying power utilized is $837, so it is an efficient trade using $837 and collecting $1.97. Now, if you look at the green area, the P&L at expiration, the $1.97 is collected up front. As long as the stock stays below the 65 strike price, we keep that max profit. We don't start losing until it moves up to 67 or above. If the stock moves up above the 65, we can still be assigned at or before expiration. In that case, we'll be short 100 shares, which is one option contract, at $65. This is still better than the current price of $61. So from here, we hit review and send, and we place the order. We are now short a 65 short naked call in Kohl's. What is a naked put option? A naked put is an option strategy where you sell a put option without owning the underlying stock. It is considered a naked put because you are naked or exposed to having the risk to buy the shares of the underlying stock at the strike price if the option is exercised by the buyer. Selling a naked put is a bullish strategy because you're expecting the stock price to go up. When it goes up, you profit. Buying versus selling a naked put. You can do either. If you sell a naked put, you are obligated to buy shares of the underlying stock at the strike price if the option is exercised. However, if you buy a naked put, you have the right to purchase shares of the underlying stock at the strike price, but you're not obligated to do so. There are several advantages to selling a naked put. The first advantage is that it can be used as a way to get into a stock at a lower price than the current market price. This is because you sell the put below the current price of the stock and hope the stock price will rise so you can buy the put option back at a lower price. However, if it doesn't rise and the price moves below your strike price, then you are assigned the stock. The price will be a lower price than the price would be if you bought the stock outright when the trade was placed. Another advantage is that it can be used as a way to generate income. This is because when you sell a put, you collect premium. This is getting paid for taking on the risk of having to buy the shares of the underlying stock. Lastly, selling a naked put utilizes less buying power than owning the stock outright. This allows the opportunity to make a higher return on investment. What are the downsides to selling a naked put? You need to be comfortable with the risk involved in selling naked puts. The biggest risk is that the stock price can go down and you may be assigned the stock. If the stock continues down, you lose money. If the stock price goes up too much, you will also miss out on additional profits that you would have had if you owned the stock outright. However, we shouldn't allow ourselves to think this way since we keep the premium collected up front. The trade will be profitable, which is what we wanted when we placed the trade. When should you sell a naked put? A naked put can be sold in several different situations. It's a good strategy to use when IVR is high and you are bullish on a stock and think the price will go up. It can also be used as a way to get a stock at a lower price. So if you're bullish on the stock and want to own it, why not sell a put and try to buy into it at a lower price? You collect premium in the meantime. Lastly, it's a good strategy to use to generate income from your investment portfolio. When you sell naked puts, you collect a premium. If you are not assigned, you can roll the put to the following month and collect additional premium. You can continue doing this every month until you are assigned. How do we sell a naked put? Selling a naked put is relatively simple. First, you need to choose the stock or ETF that you want to sell a put on. You want to make sure you're bullish on the stock and believe the price will increase. Next, you need to choose the expiration date of the option contract. I suggest selecting the date that's closest to around 45 days to expiration. We pick this expiration date to maximize profit and minimize risk. Lastly, we need to choose the strike price. This is the price we are willing to buy shares of the underlying stock at if we're assigned. That's it. That's how you sell a naked put. How are naked puts managed? When trading short naked options, selling an option of the opposing type is one way to defend the option if the price goes against us. This reduces the directional risk of the position and collects more premium, which extends the break-even point. If your assumption on the underlying has not changed as expiration approaches, the position can be rolled out to the next expiration cycle to extend the time in the trade and collect additional premium. When do we close a naked put? Profitable short naked puts will be closed at a more favorable price than the entry price, typically 50% of max profit. How do we lose with the short naked put? It's very possible to lose when selling naked puts. The underlying stock price could drop, in which case you would be assigned the shares of stock at the strike price, and your loss would be equal to the difference between the strike price and entry price minus the premium collected. The max loss for a naked put occurs if the stock price goes to zero. To better understand how selling a naked put works, let's look at an example. We're going to sell a naked put in Snap. We'll use the Tastyworks trade platform. So we're going to go to the trade tab and punch in the ticker SNAP up above in the left-hand corner. I like to use the curve mode so that we can visually see the profit zone in green. We go to the strategy tab and hit short put, and in this case we are selling the 32 strike put for $3.05 with 36 days to expiration. So we're collecting $305 immediately when placing this trade. The buying power effect that we are using is $549. So it's a cost-efficient way of investing. We're using $549 and collecting $305. Now, if you look at the green area, which is the P&L at expiration, we see the max profit is $305, which is the amount that we collected up front. As long as the stock stays above the 32 strike price, we keep the max profit. We don't start losing money until the stock moves down to just below the 29. So if it stays where it's at or even moves down a little, we still profit. If the stock moves down below 32, we can be assigned at or before expiration. In that case, we will own 100 shares, which is one option contract, at $32. This price is still better than the current price of $33.19. So at this point, we hit review and send, and we place the trade. So the short naked put strategy is a great strategy for generating income and buying a stock that you are bullish on at a better price than the current price. How do we beat the S&P 500 utilizing stock options? We beat the S&P 500 through active investing. The key is to know how much we should be in the market and how much we should be out of the market. We look at the S&P trend lines, and when the S&P is at market lows, we should have a higher percentage invested in the market. When the S&P is at market highs, we should have a lower percentage invested in the market. We should also have a higher percentage of those funds invested in neutral or bearish strategies when we're at highs, and when we are at lows, we want to have bullish strategies. Bullish strategies such as naked put options, buying leaps options, and selling covered calls. And of course, the bearish strategies are selling naked call options or naked vertical spreads and debit spreads. Going back to 2008, we can look at the SPY chart and see the current price of $410 is fairly valued, but on the mid to high end of the trend area. With IVR currently high, we will want to be pretty well invested in the market using a lot of neutral strategies. Since we are just about in the range of the trend line, we will want to have no more than 70% invested in the market. This way we have a little bit left to invest if there's a huge drop in the market, and it should also allow us to be able to cover our losses as long as we have some vertical strategies with stop losses and some neutral strategies. When the market is at all-time highs and 30 to 50% above the trend lines, I like to have a lot of money on the sidelines waiting for a drop. With the market at highs, the risk is much more to the downside versus the market skyrocketing even further up. At the same time, when the market is at lows and 30 to 50% below the trend lines, I like to be all in. By all in, I don't mean 100%. By all in, I mean about 85% or 90% invested. We should always have 10 to 15% available cash in the account to cover if necessary. With the market at lows, the risk to the further downside is limited. And just to further clarify and review, when the market is at lows, we utilize bullish strategies like selling naked puts, buying leaps, and selling covered calls. When the market's at highs, we utilize bearish strategies like selling naked calls and buying debit spreads. When the market is in between, we can use a mix of all strategies or a mix of bullish and bearish strategies. We will also typically be selling more Strangles and Iron Condors since they are neutral strategies. What is beta weighted delta and where should it be based upon the S&P 500? Beta weighting is a means for investors to put all of their positions into one standard unit. It's a way to look at an entire portfolio and understand how it will change with a move in the market. It tells us about the size, diversity, and general risk of the positions. If you have an Apple AAPL trade with a 50 delta, then you'll gain $50 for every $1 increase in the price of the stock. But that plus 50 delta is specific to a $1 move in Apple. Suppose you also had a bullish Microsoft trade with a 20 delta, a plus 20. That means you'll make $20 for every $1 increase in Microsoft stock price. As a general rule, I like to stay delta neutral for the most part. However, when the market is at highs or lows, I may adjust to be slightly more bullish or bearish. So you can also see from the chart, I like to keep a couple hundred positive deltas on when we are 40 to 50% below the S&P 500 trend lines. Likewise, when we are 40 to 50% above the trend lines, I like to keep a couple hundred of negative deltas on. The larger the account that you have, the more deltas can be added to the chart above. This chart is more for an account of $25,000 or less. So to summarize, by following these simple rules, we can adjust our option strategies and allocations to fit the current market conditions. This will help us stay ahead of the market and make money whether it's going up, down, or sideways. Remember to always stay within the allocation rules to protect your gains, limit your losses, and have cash flow available when opportunities present themselves. And don't be afraid to take profits when you have them. How do we use multiple methods to confirm our stock option trades? We use options mathematics, technical and fundamental analysis, conference calls, earnings reports, and even news to understand what percentage to be in and out of the market and which trades to put on. We also use a combination of all of these factors to determine the strategy that we're going to employ and increase our probability of profit and decrease our risk. Let's break down each method individually. What is options mathematics and how is it used? The basis for success when trading stock options is the utilization of options math. Options math is the key to understanding how options work. It's also a crucial step in understanding how to use the stock options effectively. The Black-Scholes model is a math equation that estimates the theoretical value of derivatives based on other investment instruments, taking into account the impact of time and other risk factors. It is the standard for pricing an options contract. However, don't worry, we're not going to cover it because it doesn't matter. The options prices are given to us, so we don't need to understand how they are derived. More important is that we need to understand the statistics and probabilities to be a successful options trader. As a basis for trading stock options, we first need to understand and accept the fact that the stock market is extremely efficient. There are millions and millions of people trading every day and the market moves extremely fast. Data or information that anybody receives on a stock or a company is immediately priced into the market. So there's no getting a leg up on news since everything is already priced in immediately. There's no edge that you can get in knowing information about a company in advance or having some insider knowledge. We also need to understand that in most cases, CEOs of companies don't even have a clue where their stock is going to go. They don't know how it's going to react to the market, regardless of how well they think they might be doing. To that end, we have to understand that we have no clue where a stock is going to go either. Nobody else does. We might have an assumption, an opinion, but at the end of the day, we're all typically no better than 50-50 on our guesses. We also need to only trade liquid stocks. When we trade stocks that are not liquid, we give up the difference between the bid and the ask price. So we want to trade stocks with penny wide or just a few penny wide spreads. We don't want to give away money for free. Most returns are distributed within a bell curve. This means that if we take a group of people and measure their heights, most will be at an average height with a few smaller, shorter people and a few taller people. The same is true for stock returns. Most stocks will have returns that are close to the average, with a few having exceptionally high or low returns. Most stocks will land within the one standard deviation move. In other words, within one standard deviation or a 68.2% range. We can also look at a stock chart going back to a stock's inception and apply the bell curve. Going forward in time, you can see exactly how far a stock is expected to move within a certain range and time. As we go further out in time, we can see from the curve the likelihood of the stock moving further out and making a more volatile move away from the current price. If you think about it, it makes perfect sense. More time equals a bigger possible move. It is really important to understand where a stock is expected to move within a certain period. When we understand this, we can then build an options trading strategy around it. We can take advantage of the math and place high probability trades. What is volatility? Stock price volatility is a measure of how much a stock's price or value fluctuates up and down. Implied volatility is an expectation of where the stock might move in the future. Depending on how high the implied volatility is, it will cause option pricing to increase or decrease to compensate for the volatility. If the black line is stock A, then you can see that it has very little volatility and stays in the 100 range. The frequency and magnitude of its moves are very small. Stock B in the blue has much higher volatility and makes bigger moves, even though it ends up being at the same $100 price. So you can see the normal distribution curve is pictured in green. If we take stock A from the previous example with low volatility, you can see that it causes the distribution curve to get taller and more narrow with the red graph. Now the standard deviations have moved in from further out. Now a high volatility stock will cause the distribution curve to move out much wider to compensate for the bigger swings in prices. So the standard deviation range is much wider. As implied volatility increases, an options price will increase to compensate for the higher probability of being in the money at expiration. This is why we like to sell options in high volatility and buy options when IV is low. When they are low, they have the propensity to increase in the future, which benefits us when we buy options. Likewise, when we sell options in high volatility, we are hoping for a volatility contraction, which benefits us as well. How do we pick our probability of profit? Now, with all of this data on both volatility and possible ranges in the stock price, we can build option strategies that target the probability of profit that we want. 70, 80, 90%. This is the key and the beauty of options math. If you're just trading stocks alone, your win rate is 50%. You have a 50% chance that the stock will go up in price and a 50% chance that it will move down in price. So let's take a look at putting on a strangle in Starbucks. We can pick our strike prices. So with the current stock price at $84.84, we pick and sell the $77.50 put option and the $92.50 call option right at the one standard deviation dotted lines. We collect $1.92 or $192 since one contract equals 100 shares. Now we did this on the Trade tab in table mode on the Tastyworks Trade platform. We can also quickly switch to the curve mode and see the distribution curve as well as the one standard deviation dotted lines. As you can see, the probability of profit is 68%, which is exactly what you would expect to see since we are right on the one standard deviation dotted lines. The Tastyworks Options Trading platform is what I use, and it makes everything extremely intuitive and easy. These guys also built TOS, the Think or Swim trade platform, and sold it off to TD Ameritrade, so they do know what they're doing. Now using the same Starbucks stock, let's look at picking strikes with an even higher probability of profit. Let's say that we wanted to have a 76% pop. Of course, when we increase our chances of profit and lower the risk, we will not receive quite as much in premium. But let's see. As expected, we collect $124 at the 76 probability of profit versus $192 when we go closer at the 68% pop. We can also look at this trade in curve mode and see that we are now just outside the 1 standard deviation lines at 76% probability of profit. So we have much more room to move and thus a higher probability of success. So it's really powerful how we can use these probabilities when trading to pinpoint our chances of success. And we can't replicate this with stocks since stocks always have a 50-50 chance of success. So now we better understand how options math is critical to success when trading options. By understanding and using options math, we can pick strike prices with the probability of profit that we want. This increases our chances of success as an option trader. Our main goal moving forward to be successful is to make as many small, high probability trades as possible on the right side of volatility. What is fundamental analysis? Fundamental analysis is a bottom-up approach that focuses on a company's intrinsic value or real value. This type of analysis looks at a company's financial statements as well as other public information to determine its true value. It includes looking at all of the numbers to find that value of the stock. PE ratio or price to earnings ratio is one of the key metrics that you'll want to consider. This is the current stock price divided by the earnings per share. This number can range from single digits to over 100. A higher PE ratio means that the investors are willing to pay more for each dollar of earnings. PEG is price to earnings growth ratio. PEG is the PE ratio divided by the expected earnings growth rate. This number will typically be less than 1. PS, price to sales ratio, is the current stock price divided by the revenue per share. This number can range from single digits to over 10. PB is price to book ratio. Price to book ratio is the current stock price divided by the stock book value per share. The book value is found on the balance sheet and is equal to total assets minus total liabilities. This number can range from single digits to over 5. Enterprise value, or EBITDA, is earnings before interest, taxes, depreciation, and amortization. This number is found by adding the market value of the equity to the market value of the debt and then subtracting out the cash. This number can range from single digits to over 20. It can give you a good idea of the value of the company as a whole. Cash position of a good company should be at least 10% of the total assets. And the debt of a good company typically should be less than 3 times EBITDA. This helps to ensure that the company can pay off debt if needed. They should also be able to better withstand a downturn in the market for some time until the market recovers. Fundamental analysis is a great way to look at a company's strength from a real numbers perspective. You can compare against others in the industry and decide if the company is poised for growth or at risk of going under or falling. Technical stock analysis is the study of past price changes and trading volume to make predictions about future price movements. It can be used to make investment decisions about individual stocks as well as to identify trends in the market as a whole. Besides being used to identify trends and when to buy or sell a stock, technical analysis can also be used to identify support and resistance levels. What are some of the most important factors to consider when doing technical analysis? There are a few important factors to consider. First, you need to look at the price action of the stock. This includes things like the stock's opening and closing prices, as well as the highs and lows for the day. You can use this information to identify trends in the stock price. Secondly, you should look at trading volume. This is the number of shares that are traded each day. High volume usually indicates that there's a lot of interest in a stock, while low volume may indicate that there's less interest. You also need to look at technical indicators. These are math formulas that are used to predict future price movements. Some common technical indicators include simple moving averages and RSI, which is the relative strength index. You should also look at chart patterns. These are recurring patterns that can be used to predict future price movements. I use the free charts on yahoofinance.com. The candlestick charts are the best. They show the opening and closing price as well as the high and low price. Green means the closing price is higher than the previous day's closing price. Red means the opposite. The hammer is a bullish reversal pattern that forms after a period of decline. The pattern is composed of a small body with a long lower shadow. The long lower shadow indicates that the stock was trading lower at some point during the day but closed near the high. This shows that there was buying pressure present even though the stock was down for most of the time. An inverted hammer at the top is a bearish reversal pattern that forms after a period of price increases. The long upper shadow indicates that the stock was trading higher at some point during the day but closed near the lows. This shows that there was selling pressure present even though the stock was up for most of the day. The engulfment is where the body of the second candle engulfs the body of the first candle. With a bullish engulfment, the body of the second candle is positive. With a bearish engulfment, the body of the second candle is negative, or the stock closes lower than the previous day. Here's an example of a bearish engulfment and a bullish engulfment. The piercing line is a two-candle bullish reversal pattern. The bullish candle mirrors the bearish candle as buying pressure increases. Here's an example of the piercing line bullish reversal. The morning star is a bullish reversal pattern and the evening star is a bearish reversal pattern. Here are examples of the morning star and evening star. The doji is a candlestick pattern that indicates indecision in the market. In other words, the bears and the bulls are even. Here's an example of a doji. The spinning top has a short body with longer shadows about equal above and below. Here is an example of a spinning tops. The hanging man is a candlestick pattern that indicates the market is ready to turn bearish. It is also the bearish form of a hammer. Here's an example. The head and shoulders is a chart formation that signals a potential reversal in the current trend from increasing to decreasing. The inverted head and shoulders is a chart formation that signals a potential reversal in the current trend from decreasing to increasing. Here's a chart showing the head and shoulders. And here is another chart showing the head and shoulders inverted to where it goes from negative to positive. What are the different stages of a stock? The first stage is accumulation. This is where smart money starts to buy the stock. They are buying because they believe the stock is undervalued. The stock is bracketing or basing at this stage. The longer a stock accumulates, the more pressure is built up, and this often leads to a longer breakout period. The second stage is the breakout. This is where the stock price breaks out of a trading range or resistance level. The price oscillates, but the overall trend is upward. Swing traders typically want a 5% return during a breakout. A breakout can be followed by a peak or another accumulation phase. Always sell when you can and not when you have to. This is the key when trading a breakout. Down moves can happen fast and be big since they are often fear-based. It's normally best to set a goal and not be greedy. The third stage is the peak. This is where the stock price reaches its highest point and starts to sell off. The fourth and final stage is the sell-off. This is where the stock price falls back to its original trading range. Bearish pressure increases. What are support and resistance levels? Support and resistance levels are the result of market supply and demand. Resistance levels, when broke, become the next support level. In turn, when support levels are broken, they become the next resistance level. I like to think of it as a bouncing ball breaking through a ceiling or basement and bouncing in the attic or basement at another level. What kinds of lateral stock movement are there? There's bracketing, congestion, and consolidation. Bracketing is when the stock price is confined to a tight range and is unable to make new highs or new lows. Congestion is when the stock price is moving back and forth but not making any progress. It is moving erratically and not making any progress at all. You would want to avoid investing in a stock that is showing congestion since it is unpredictable. Consolidation is when the stock price is consolidating and it's trading in a very tight range. This is a positive form of bracketing, and we look for it to move higher as soon as it breaks through its resistance level.
What are some of the technical sell signals that we can look for? Multiple failed attempts to break through a resistance level is one. If a stock falls below a support line and the support then becomes a new resistance level. If a stock makes a new low below 2 to 3 previous lows, that is a pivot low. And lastly, a lateral pattern of congestion at a peak. What is stock volume? Think of stock volume as energy directed to a stock on that day. What are the rules of stock volume? Price movement should always follow volume expansion or contraction. When volume expands, the price typically expands higher or lower. When volume contracts, the price movement typically contracts. When volume expands and the price doesn't, it is called price-volume divergence. This is a technical signal. It usually means that it is a negative confirmation of the price correction. It can also mean that the price expansion is delayed. What are some of the key volume strategies to look for? Look for a stock to break out of a well-established base on high volume. Also look for volume to contract when the price contracts. If volume contracts during a price contraction, then most investors are holding and not selling. On the other hand, if volume does not contract during a price contraction, then many investors are likely selling. A high volume price contraction is a key bearish technical signal. This is bad and many investors are likely selling. If a stock is seeing rising volume while in the accumulation stage, this is a buy signal. Time to get in. If a stock is in a multi-day uptrend and volume is tapering off, especially with a doji or spinning top pattern, then profits should be taken off the table. This means that demand is lowering. Always pay attention to a volume spike, especially in an overextended up or down trend. A high volume spike is often a precursor to a price reversal. What is a trend line? A trend line is a tool used in technical analysis to identify the direction of a stock's price movement. A bullish trend line is an upward sloping line that indicates that the stock's price is increasing. A bearish trend line is a downward sloping line that indicates that the stock's price is decreasing. What are some popular stock price indicators that we can use? SMA, simple moving average, is one. The simple moving average is the arithmetic mean of a given set of values, and it's plotted on a line on a stock chart. There's the 20-day, the 50-day, the 200 SMA, simple moving average, are often used to identify trends. The 200-day simple moving average is also called the power line, and is a very strong resistance for the stock. SMAs are lagging indicators since they are derived from past prices. They work best with the stock in the breakout or sell-off stage. When trading laterally, it is not a good indicator. The optimal buy signal for a stock based on SMA is having them all in order from lowest to highest on the chart. RSI is the Relative Strength Index, and it's another good technical indicator. The Relative Strength Index is a momentum oscillator that measures the speed and change of a stock's price movements. It measures the strength of a stock compared to its own price history. The RSI is plotted on a vertical 1 to 100 scale. An RSI below 30 is considered oversold, and above 70 is considered overbought. In a bull market, many stocks trade above the overbought territory. Likewise, in a bear market, many stocks trade below the oversold territory. Here's an example of a breakaway gap. There is a higher opening on high volume, and it's followed by a solid uptrend. Here's an example of an exhaustion gap. It takes place during an overextended uptrend. It's usually followed by a peak and then a sell-off. This is when you want to take your profits off the table.
Here is a runaway gap that occurs midway into a strong uptrend or downtrend. This is a healthy gap. And here is a chart showing all three types of gaps. These are the basics of technical stock analysis. You don't need to be an expert to get started, but it's important to understand the basics. You may find some setups that you like and have success with and use more than others, and that's great. Just another tool to help you with your option strategy selection. How do we use conference calls, quarterly earnings reports, and news for stock option trade analysis? Qualitative stock fundamentals consider all the news, earnings releases, rumors, etc. that a company puts out. They also look at analyst reports and conference call transcripts to find out what's going on with a company. Some of the things that qualitative stock analysis looks for are changes in management, new products, services, if they're expanding or not, the industry as a whole, and the competitors, the business model that they have versus the competition, the prospects for growth, and any risk factors. All of these factors can be found either on the quarterly reports or the conference call transcripts. The conference call transcripts can be found on the web by Googling call transcript and the company, such as DraftKings or Coke. The entire transcript from the call reviewing the quarterly earnings report will be available. The Motley Fool does a good job of posting the transcripts for most of the publicly traded stocks. What are the two phases of becoming a successful options trader? Well, it's preparation and execution. The preparation is all the things that we just covered. It's the options math, learning the individual trade strategies. It's knowing how to use technical and fundamental analysis, conference calls, earnings reports, and even news to understand which strategies to use and where there are opportunities. The execution is putting on the options trades. It's utilizing the correct strategy for the current market. It's evaluating and knowing the right stocks and managing the trades once they are placed, as well as knowing when to close them or roll out to the next month. This is where a coaching program can be a huge benefit and shorten the learning curve. All right, thanks for watching. This was a long one. If you stayed till the end, I really appreciate it. I know it seems like a lot of information. However, it really isn't that difficult. It also doesn't happen overnight, and you don't become a master of all the strategies in just a month or two. If you are considering investing in trading options, the most important thing is you need to enjoy the stock market, evaluating companies, and making money. If you enjoy it, you'll learn and you'll make a lot of money. Lastly, if you're interested in learning about the coaching program, please shoot me an email at darren@darrensteves.com, and we can book a 15-minute video call and we can talk about your goals and if you may be a good fit for the options coaching program. I have helped many students that knew nothing about options set up an account from scratch and begin trading. We go through some initial trades and I'm there to answer any questions that they have. You can also watch videos and read books and learn it on your own. However, I've got to say that it is beneficial to have someone that's traded options successfully for many years. Whether it be myself or someone else, I highly recommend getting a coach in the beginning if you're serious about trading options and growing an options account. It will save you a lot of time and probably a lot of money, as it will likely prevent you from putting on some questionable trades and help you with making trades with a high probability of profit. The people that I work with make all of their own trades themselves. I just oversee, answer any questions, and offer my opinion based on experience. I'm also happy to share exactly what I'm doing in my options account as well. So it's a collaborative process where you learn much more quickly. So please reach out to me through my email and we can book a 15-minute call. I look forward to meeting you and trading together. Happy trading and make it a great day.